Hey everyone, welcome back. Today, we're diving into something that I think a lot of us have probably heard tossed around, maybe even tried ourselves, but maybe don't fully grasp. The whole buying the dip thing. Basically, you're trying to snag stocks when their price takes a temporary hit, hoping to ride the rebound for a profit. So we're going to unpack that, look at how it actually works, some examples, the risks, the whole shebang. First off, though, I think it's good to clarify what we're even talking about. Like, what actually constitutes a dip? Is there like a magic percentage drop? How does this all tie into concepts like dollar cost averaging? Plus, psychology behind it is fascinating. It kind of goes against our natural instinct to like run for the hills when things get shaky. So yeah, tons to cover. Let's get into it. So when we talk about buying the dip, we're essentially talking about a strategy that, aims to capitalize on those temporary price drops in stocks. The idea is that instead of panicking when a stock you like goes down, you see it as a chance to buy more shares at a discount. It's all about that long-term perspective, right? You're betting that the dip is just a blip and the stock will eventually climb back up. But of course, there's no guarantee of that. And that's where things get tricky. So let's say you're eyeing a stock that's usually around $50 a share. Then bam, some news hits, maybe a bad earnings report or something, and the price tumbles down to $45. Now, for some folks, that 10% drop might be the signal they're looking for to jump in and buy the dip. But, it's important to remember that there are always risks involved. The dip could keep dipping. The news might actually signal some deeper problems with the company. So how do you know when a dip is a genuine opportunity versus like a sign of trouble? And that's where things like research, risk tolerance, and frankly, a bit of gut feeling come into play. But even with all that, it's not always easy to call. And here's where things get even more interesting. This idea of buying the dip isn't like totally separate from another investing concepts we hear a lot about. Dollar cost averaging, sometimes shortened to DCA. You see, dollar cost averaging is all about investing a set amount of money at regular intervals, regardless of what the market's doing. So you might buy $100 worth of a stock every week, whether the price is up, down, or sideways. The logic is that, over time, you're smoothing out your average purchase price. Now, buying the dip can kind of be seen as a more, I guess you could say, active version of DCA. Instead of just blindly buying at fixed intervals, you're specifically waiting for those price dips to pounce. And by buying more shares when the price is lower, you're bringing down your average cost per share even faster. To make this a little more concrete, let's imagine a scenario. Say you bought 200 shares of a company, we'll call it XYZ, at $14 per share. That's a $2,800 investment right there. But then, XYZ hits a rough patch. Maybe some bad news comes out or the overall market takes a tumble. Whatever the reason, the stock price drops to $11 a share. Now, if you're still bullish on XYZ long term, this dip might look like a pretty sweet buying opportunity. So you decide to buy another 100 shares at that reduced price, shelling out another $1,100. Now, you've got 300 shares in total, and you've invested a total of $3,900. But here's the key. Your average cost per share is no longer $14. It's now $13, meaning even if XYZ doesn't immediately rocket back up to $14, you're in a better position to profit once it recovers. That's the power of buying more shares during a dip. It lowers your break-even point, giving you a little more cushion. But here's the thing. Buying the dip often goes hand in hand with another strategy, selling the rip. Have you heard of that one? It's kind of like the flip side of the coin, where buying the dip is about finding low points to buy. Selling the rip is about identifying those peaks where you can cash out for a profit. The idea is to ride those price waves, buying low and selling high. Sounds great in theory, right? And for some skilled traders, it can be a lucrative approach, but, and this is a big but, a lot of financial experts warn against trying to time the market this way. It's really tough to consistently predict those short-term price swings. And more often than not, you might end up selling too early or buying too late. But let's put this into some historical context. Imagine an investor who lived by the buy the dip rule, specifically buying whenever the S&P 500 dipped by 10%. How would they have fared over, say, the last decade? Well, as it turns out, that strategy would have been pretty successful over the past 10 years. The market has generally trended upwards, and there have been several 10% dips along the way. So those dips would have presented some prime buying opportunities. But here's the catch. There's no guarantee that a dip will stop at 10%. Sometimes those drops can get way more intense. Like, remember the beginning of the whole COVID-19 pandemic? Between mid-February and mid-March of 2022, the S&P 500 didn't just dip 10%, it plummeted over 30%. So if you were religiously buying at every 10% drop, you might have ended up buying a whole lot more as the market kept tanking. Not ideal, right? And that brings us to a crucial point. To really get buying the dip, you got to understand market cycles. See, stocks and the market as a whole don't move in straight lines. They go up, they go down, they have those little rallies and pullbacks, and these fluctuations often happen within broader long-term trends. So even a stock that's generally on an upward trajectory is going to have those dips along the way. And this concept of market cycles isn't exactly new. Charles Dow, the guy behind the Dow Jones Industrial Average, was one of the first to really recognize these patterns. This was over a century ago, so we've been aware of this for a while now. And since then, a whole bunch of market technicians have developed methods to try and, basically profit from these cycles. They use all sorts of patterns and technical indicators to figure out when the market might be at a low point, a good time to buy, or a high point, a good time to sell. But, and there's always a but, consistently outperforming the market this way is really, really hard. There's a ton of debate about whether it's even possible for most investors to do it reliably. And one of the reasons it's so tough is that there's so many different types of market cycles. It's not just one neat and tidy cycle that repeats itself over and over. There's the general business cycle, which looks at how the overall economy expands on tracks. Then you have the four-stage cycle. That one goes through accumulation, markup, distribution, and markdown. Basically, it's about how prices rise, peak, and then fall again. But wait, there's more. You also have psychological cycles, which try to track how investor sentiment shifts over time, like from fear to greed and back again. And then you've got things like wave-based cycles, calendar cycles, sector rotation cycles, even presidential cycles. It's a whole lot to wrap your head around. And that's part of the challenge with buying the dip. There's no one-size-fits-all answer to how often these dips happen, how big they get, or how predictable they are. It's a bit of a guessing game, which is why some people prefer to just stick with passive investing, like index funds and such. They don't want to try to time the market at all. But speaking of timing, let's talk about the duration of these market cycles. How long do they actually last? Well, the thing is, they can vary wildly. Some might be pretty short, lasting just a few months. Others can drag on for years. And that's what makes it so tricky to figure out whether a dip is a temporary blip or the start of a much longer downturn. Looking back at historical charts, it's easy to spot those buy-the-dip moments that would have made you a fortune. Hindsight is 20/20 with me. But when you're actually in the moment, facing a dip in real time, it's a whole different story. You don't know for sure if it's a buying opportunity or the beginning of a prolonged slump. Talk about a tough decision. Now, while market cycles might not be perfectly predictable, most people agree that they do exist. And there are a bunch of theories about what drives them. Some explanations focus on, basic economic principles like supply and demand. Others look at the natural ebb and flow of business expectations over time. And some even get into like mathematical patterns or calendar cycles and seem to line up with market movements. But one of those popular theories out there is that market cycles are heavily influenced by human emotions and biases. I think about the fear of missing out, or FOMO. That can really push prices up during a rally, or overconfidence, which might make investors ignore those red flags and warning signs. On the flip side, fear and panic can drive those massive sell-offs during a downturn. It's all about psychology. And Charles Dow, that guy we mentioned earlier, even compared the market to a barometer of investor sentiment. He said it reflects the overall optimism or pessimism of the crowd. And today, a lot of people still talk about market cycles in terms of fear versus greed. Those two emotions, fear and greed, can really amplify those market swings. So over the years, market technicians and folks who study these cycles have come up with a ton of metrics and indicators to try and help investors make those tough buy to dip or sell the rip decisions. And there's a whole smorgasbord of tools out there. But it's important to remember that no single indicator is foolproof. None of them can tell you with absolute certainty when a market pick or trough is happening. But when you look at them all together, they can give you a pretty good sense of whether the market's offering a sweet deal or if it's time to take your profits and run. So let's break down some of these indicators. First, you got your economic indicators. These give you a snapshot of the overall health of the economy. Things like GDP growth, unemployment rates, inflation, stuff like that. Then there are price and momentum indicators. These analyze past trading data to spot trends and potential turning points. Moving averages, relative strength index, those sorts of events. You also got options indicators, which can hint at what investors are expecting in terms of future price movements. Then there's volatility, which measures how much the market's swinging up and down. The VIX index is a popular one for tracking volatility. And there are even more specialized indicators, like the ratio of demand for bonds compared to stocks, the level of margin debt, which is basically how much money investors are borrowing to buy stocks, and various sentiment indicators that try to gauge the overall mood of the market. Oh, and let's not forget about all those technical indicators. Those are based on chart patterns and price action. There's a whole lot to take in, I know. But as an example, let's look at CNN's Fear and Greed Index. This one's pretty popular. It basically combines 7 different indicators to give you a sense of whether investors are feeling fearful or greedy. It looks at things like the S&P 500's performance, how many stocks are hitting 52-week highs and lows, the volume of trading in rising versus falling stocks, the put-call option ratio, the spread between junk bond yields and investment-grade bond yields, that VIX volatility index we talked about, and the difference between stock yields and treasury bond yields. So I looked at this index. You can kind of get a feel for the overall sentiment of the market. And some investors believe that extreme readings, either extreme fear or extreme greed, can signal potential turning points. So they have it. Buying the dip. It's a strategy built on the idea that stock prices don't go up in a straight line. They have those ups and downs, those cycles. And by understanding these cycles, you can potentially snag some bargains and boost your returns. But, and I got to emphasize this, it's not a risk-free strategy. Those dips can keep dipping, and timing the market is notoriously difficult. So before you jump in, think about your own investment timeline, your risk tolerance, and do your research. There's a lot to consider. Oh, and if you're finding this whole discussion helpful, hit that like button and subscribe to the channel. It really helps us out. That's all for today, folks. Thanks for tuning in.